And since the debt problem isn't going away anytime soon, I don't think the macroeconomic problems or the currency problems or the bubble asset risks are going away anytime soon either. So we have to just, again, the facts haven't changed. They're just getting worse and worse. And so the themes stay the same for me. And we can unpack those at the individual level, but we're now trapped. We're trying as a country and as a nation and as a world hitting 400 trillion in debt in the next few years. That's literally like trying to swim with a cannonball strapped to your ankle. Growth is now, I think, mathematically impossible, whether you're reading David Hume from the 1750s, or Reinhardt and Rogoff, von Mises, or simple common sense from Ernest Hemingway, or even our own personal common sense, whether you're a family, a company, or a nation. When your debt levels are 3 times your income levels and you're strapped, I don't know how you can project growth optimistically, even in a political environment where there's a lot of optimism out there to get elected. I think the Fed, the White House, the Parliament, the ECB, et cetera, they're all trapped, and they're all desperately trying to reduce rates to save their bond market at the expense of their currency market. It's from China to the Swiss National Bank to the Bank of England to the Fed. We're just seeing a lot of desperate chickens squawking in the yard, pecking at each other, but getting really nowhere. Talking before, the themes haven't really changed and the facts haven't changed. They've just gotten worse and worse. And, when the facts change, your opinions change. But right now, the key, look, everyone agrees now at this point that the key theme in the global economy or sovereign economies is unsustainable debt and what that does, and the ripple effects of what that debt does to every asset class, and certainly precious metals and currencies and credits and equities. So, we've just reached a point of the irrational, and I know that theme seems like beaten over and over, but the data just keeps getting worse and worse. And so you can't talk about the economy or even the markets, which are very dislocated from the economy. I mean, we've got recession now in Germany. I spent a lot of time in Germany. The mood, the facts, the data is pretty scary there. But, China's clearly on its knees as well. This is a interesting time for the UK and even the US. So, separating markets from the economy is important. Understanding the macroeconomy or the sovereign economy means understanding debt. And again, sometimes people throw data and facts out there, and it just becomes abstract when you're talking trillions or percentages. It's just important to keep in mind, in 1971, when they decoupled from the gold standard, I think the U.S. debt to GDP was just shy of 40%. I think it was 38%. And government public debt was 425 billion. And it didn't even pass trillion until we got into the Reagan era. But today that debt to GDP is at 125%, and public debt is 35 trillion and counting. You have to think about that. It's not just the extraordinary explosion in the debt, the exponential explosion, it's also the pace of it. It took us 220 years in the United States to get to 11 trillion in public debt. And in the last 4 years, we've added another 11 trillion in public debt. So again, these aren't meant to just be statistics that you throw out there to try and look clever. The ramifications are massive. And the Congressional Budget Office in the US is already, projecting another, I think, 20 trillion in IOUs in the next 10 years. That's crazy. And you can talk about fiscal spending. I don't think it's going to come down that much. And in the next 3 years, we have to roll over about 15.5 trillion in US treasuries at a higher yield, despite the coupon being fixed at 2.3. The yields are around 5%. So the yields are double the sticker price. So where does that money come from to refinance these grotesque debt levels in just the US, which is the home of the world reserve currency and the tier 1 asset 10-year US Treasury? You can't ignore the reality of what debt does to these economies and the ripple effects it has on currencies and markets. So when you just look at that and what that's done, everything starts there and everything ends there. Whether we talk about currencies, precious metals, equities, credits, it all comes back to how that debt has central banks trapped, how that debt has the Fed trapped in particular, and what that means to the man on the street, what that means to the bottom 90% or even the top 10% in the wealth inequality spectrum. The inflationary effects of that, the currency debasement effects of that. And then if you just look at the raw numbers on recession data, whether it's bankruptcies, unemployment levels, U6 unemployment levels, debt-driven CPI growth, which is pretty anemic. It's not meant to be negative for negative sake, but I can't be possibly bullish right now. I don't know how anyone can. That doesn't mean markets can't continue to go up, but you're measuring it against a currency that's going down. So there's just so many overlapping themes, Anthony. But to make a long answer even longer, the debt really defines the global macro right now, and it defines all the asset classes that we discuss under it, and it even defines some of the geopolitical desperation we're seeing in the world. So, and since the debt problem isn't going away anytime soon, I don't think the macroeconomic problems or the currency problems or the bubble asset risks are going away anytime soon either. So we have to just, again, the facts haven't changed, they're just getting worse and worse. And so the themes stay the same for me. And we can unpack those at the individual level, but we're now trapped. We're trying as a country and as a nation and as a world hitting 400 trillion in debt in the next few years. That's literally like trying to swim with a cannonball strapped to your ankle. Growth is now, I think, mathematically impossible. Whether you're reading David Hume from the 1750s, Reinhardt and Rogoff, von Mises, or simple common sense from Ernest Hemingway, or even our own personal common sense, whether you're a family, a company, or a nation, when your debt levels are 3 times your income levels and you're strapped, I don't know how you can project growth optimistically, even in a political environment where there's a lot of optimism out there to get elected. I think the Fed, the White House, the Parliament, the ECB, et cetera, they're all trapped, and they're all desperately trying to reduce rates to save their bond market at the expense of their currency market. It's from China to the Swiss National Bank to the Bank of England to the Fed. We're just seeing a lot of desperate chickens squawking in the yard, pecking at each other, but getting really nowhere. Objectively, fiscal deficit spending can give you stimulus. You can get growth. Rate cuts can give you growth in the equity markets. Rate cuts can help debt markets expand and give you a little juice, but they're long-term. I think they're long-term disastrous. And in terms of the growth that we're seeing, and even in you look at GDP, to me, debt-driven growth is an oxymoron. Debt is like steroids. You can get stronger from the steroids, but you get the muscle pains and you get the physical reactions later. Or a martini can give you a buzz growth, but you get the hangover later. I don't consider deficit spending or twin deficits in the U.S., for example, as a good sign of growth. Of course, you can borrow your way into more growth, but that just postpones an eventual hangover or an eventual currency devaluation or eventual risk in the credit markets. So we can extend and pretend, to Luke Roman's point, these markets could go on for another 5 years based on just more solving a debt problem with more debt paid for with debased currencies in some direct or indirect way from central bank policies. But that growth and that buying of time always gets a hangover at the end. It always gets paid off at the backs of the consumer and at the backs of, I think, the middle class more than anyone. But yes, you can have growth. Debt-based growth is growth, but it's false growth in my mind. And I think at the end of the day, as Luke said, this could go on for 5 years or could end Monday. There's so many different needles, whether they're geopolitical or monetary or social, that are pointing at this debt balloon that no one can really predict. What will it be? Will it be a banking crisis? Will it be a mean reversion in the equities market? Or will the S&P just be nationalized with more support from the Fed and it continue to grow higher? We can talk about that. But to me, growth based on extraordinary debt and extending and pretending and rolling over debt, I think one of the reasons Powell had to cut rates by 50 basis points is we do have $15.5 trillion in U.S. Treasuries that need to be refinanced the next 3 years. Higher for longer made that impossible. We had to bring it down because Uncle Sam couldn't afford U.S. Treasuries at those yield levels. And frankly, foreign investors or foreign debtors that are tied to dollar-denominated debt is trillions, over 13 trillion. If those rates are too high, they have to sell U.S. Treasuries just to get U.S. dollars to buy oil. And so that means a massive new supply of U.S. Treasuries into an already unloved market. When you have more supply of U.S. Treasuries into the market, that sends yields up. That's the real interest rate, not the Fed funds rate. And so then you have to print more money to control those yields and support those bonds. So it's just spinning and spinning and spinning. And yes, in the mix of all that nonsense, you can get shoots of growth. But growth based on debt, to me, at the levels of debt we're at now, there are normal levels of debt and there are irrational levels of debt. Growth at this point, at the debt levels that we talked about in the intro, is simply adding more kerosene to the Folgers can, and the matches around that can just continue to be the same and get worse. And again, no one can predict what match will light that can, or whether we can just keep trying to postpone that implosion. And we can make an argument that we can take the MMT fantasy of the modern monetary theory, which I've said many times is neither modern nor monetary nor a theory. It's been tried in the 18th century. It's been tried in Yugoslavia in the 90s. It's been tried in the 20th century in Spain, Italy, and Weimar. It never works, but it buys time. It buys votes. It even buys the Nobel Prize for Bernanke. but it's temporary prosperity at the expense of permanent ruin through inflation of the currency. So yeah, we can talk about growth. I disagree. I think yes, empirically you can show nominal growth, but inflation adjusted real growth and then the kerosene to the debt pile that we already have just buys time. And we're all walking on very thin ice, whatever asset class we're looking at, except for I think hard assets. For this current environment, hard assets are, and particularly precious metals, despite my bias, are poised and positioned quite well. Look, obviously August we had the Japan carry trade, and I thought it was a joke that Japan was like a prop desk for the West in general. You could arbitrage lower rates there, borrow in yen, convert it to dollars, speculate and arbitrage and lever in the S&P or the NASDAQ, and you could do it in Australia as well, because the yen was so cheap, and that worked because of that carry trade. I think the bigger carry trade is the US dollar. That also needs to be cheap. That's why we have to cut rates now, because higher rates and the higher cost of money slows everything down in a debt tailwind world economy, certainly a debt tailwind US economy. And so you can look at Fed policy, and to your point, you can look at the balance sheets of companies, or you can look at what happens in China. I mean, China's interesting for a lot of reasons. I mean, China, of course, just cut rates as well, like everybody else. China has so many problems, but they've got too many RMB loans, too many yuan-based loans, and not enough banking reserves. And in addition to cutting rates, the People's Bank of China and the government of China, in addition to cutting rates, they're also cutting down the banking reserves from 18% to 15% to 10%. So there's less and less capital to back up those risks. And there's a lot of very risky loans, not just commercial real estate loans or residential loans on Chinese bank balance sheets. They're really sick banks. And if you listen to Thomas Hernig, former Kansas City Fed president, who's very blunt and much more honest than Powell, we have the same problem in the US banks. They may be too big to fail, but they're too rotten to succeed in my mind, because we also have a similar case of, not only did we have 600 billion worth of really underwater US treasuries on bank balance sheets, but you had trillions in non-performing loans, and you still have them in commercial real estate in particular. So banks' capital to asset ratio, which is far more important than risk-weighted capital, which is nonsense, but their capital asset ratio is at 7%. If that goes to 4 or 5%, you have a real risk of bank failure. Too big to fail banks will always be bailed out in some direct or indirect way. Smaller banks may get smacked, and we're seeing their exposures. But those type of weaknesses in the banking sector, and those kind of weaknesses, those are very universal in major power company or major economic powers like China and the U.S. That's scary. To see Germany's exports, to see Germany's industry, to see Germany's inflation, to see Germany's recession standards. When you're seeing that at the same time that China's in trouble in the U.S. banking system, the Chinese banking system are in trouble, and we see the ECB and the PBOC and the Fed all cutting rates simultaneously, that's a scary indication, because cutting rates is always a sign of weakness and not strength. And you're seeing weakness globally now. I think that's what separates this current macro and market backdrop from even 2008, which was a contained crisis in subprime real estate or MBS and ABX trade and those mortgage-backed securities and a real estate bubble. But China and Australia and other countries it wasn't a universal crash in 2008 like it is now. It wasn't universally sick.